I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. Bonds: The Unbeaten Path to Secure Investment Growth by Hildy Richelson is a comprehensive guide to investing in bonds. If you are new to investing or looking for a safer option for your portfolio, this book is a great place to start. Richelson does an excellent job of explaining the fundamentals of bonds and their place in a balanced investment portfolio. She explains the different types of bonds, how they work, and how they are rated by agencies like Moody's and Standard & Poor's. She also breaks down the risk and return characteristics of different types of bonds, including government bonds, corporate bonds, municipal bonds, and more. One of the things I appreciate about this book is that Richelson doesn't just tell you about bonds, she shows you how to invest in them. She provides step-by-step guidance on how to evaluate bonds and build a diversified bond portfolio that meets your financial goals. She also offers practical tips on how to buy and sell bonds and how to manage your bond portfolio over time. What sets bonds apart from other investment books is Richelson's focus on the unbeaten path of bond investing. While many investors focus on stocks and mutual funds, Richelson argues that bonds are an underappreciated asset class that can provide steady income and growth with lower risk than other investments. She shows how bonds have historically outperformed stocks during periods of economic turmoil and how they can provide a buffer against market volatility. While bonds is aimed at individual investors, it is also a valuable resource for financial advisors and anyone who wants to learn more about fixed income investing. Richelson's writing style is clear and concise, and she uses real-world examples to illustrate her points. She also provides helpful charts and tables throughout the book to help readers understand key concepts and data. Overall, I highly recommend Bonds: The Unbeaten Path to Secure Investment Growth to anyone who wants to learn more about bond investing. It's a well-written, informative, and practical guide that will help you build a more diversified and secure investment portfolio. Whether you're a novice investor or a seasoned pro, you're sure to learn something new from this book. Point 1 in the book Bonds: The Unbeaten Path to Secure Investment Growth by Hildy Richelson suggests that bonds are an often overlooked investment that can provide steady income and growth with lower risk than other investments. While many investors focus on stocks and mutual funds, Richelson argues that bonds are a critical asset class that can play an essential role in building a diversified investment portfolio. Bonds are a type of fixed income investment that pays interest over time and returns the principal at the end of the bond term. Unlike stocks, which represent ownership in a company and can be volatile, bonds are considered safer because they have a fixed interest rate and a set maturity date. As a result, they provide a predictable stream of income, which can be reinvested to compound growth. Bonds have historically outperformed stocks during periods of economic turmoil, making them an excellent choice for risk-averse investors. In times of economic uncertainty, investors often flee to the relative safety of bonds, driving up bond prices and pushing down yields. As a result, bond investors can benefit from increased demand for bonds during market downturns. In addition to providing steady income and growth, bonds can also serve as a buffer against market volatility. When stocks and other riskier investments experience significant fluctuations, bonds can provide stability to an investment portfolio. Bonds have a low correlation with stocks, meaning that when stock prices fall, bond prices often rise, providing diversification benefits. Overall, Richelson's point is that bonds can provide a valuable source of income and growth with lower risk than other investments. While they may not provide the high returns associated with stocks, bonds can be an excellent choice for investors looking to build a more secure and diversified investment portfolio. Point 2 in the book Bonds: The Unbeaten Path to Secure Investment Growth by Hildy Richelson argues that bonds have historically outperformed stocks during periods of economic turmoil and can provide a buffer against market volatility. This claim is supported by a long history of market data that shows that bond investments tend to be less volatile and offer better downside protection than stocks during market downturns. During economic downturns, investors tend to shift their investments from riskier assets like stocks to safer assets like bonds, driving up demand for bonds and causing bond prices to rise. This phenomenon has historically led to better bond returns during periods of economic turbulence, and it highlights the diversification benefits of holding bonds in an investment portfolio. Moreover, bonds can provide a buffer against market volatility, especially for investors who are nearing retirement or who have a shorter investment horizon. As investors get closer to retirement, they tend to become more risk-averse and shift their investments away from stocks and toward bonds. By holding a diversified bond portfolio, investors can limit the impact of market volatility on their overall investment returns and ensure that they have a reliable stream of income during their retirement years. In contrast, stocks tend to be more volatile than bonds and can experience significant price swings during economic downturns. The high volatility of stocks can result in significant losses for investors, particularly those who are heavily invested in equities. Overall, Richelson's point is that bonds can provide a safe and reliable investment option during times of market turbulence, and can help to cushion the impact of market volatility on an investment portfolio. By including a diversified mix of bonds in an investment portfolio, investors can potentially enhance their returns while minimizing the impact of market volatility on their overall investment performance. Point 3 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson highlights that bonds can provide predictable income through interest payments, which can be reinvested to compound growth. This predictable income stream is an essential benefit of bond investing, as it can help investors to plan for their future income needs and to achieve their long-term financial goals. When an investor buys a bond, they are essentially lending money to the bond issuer, such as a government or corporation. In exchange for this loan, the bond issuer agrees to pay interest to the bondholder over the life of the bond. The interest payments are typically made twice per year and are based on a fixed interest rate that is determined at the time the bond is issued. The predictable income provided by bond investments can be reinvested to compound growth over time, further enhancing the investor's returns. By reinvesting the interest payments back into the bond portfolio, investors can take advantage of the power of compounding, which can lead to significant long-term growth. Moreover, predictable income from bonds can help investors to manage their cash flow and plan for future expenses. For example, retired investors may rely on bond income to supplement their retirement income and cover their living expenses. By investing in bonds with a range of maturity dates, investors can create a steady stream of income that meets their specific financial needs. Overall, Richelson's point is that bonds can provide a predictable and reliable income stream that can be used to meet long-term financial goals. By investing in a diversified mix of bonds with different maturities and credit ratings, investors can achieve a balance of risk and return that meets their specific needs and objectives. Additionally, by reinvesting the interest payments back into the bond portfolio, investors can take advantage of compounding and achieve significant long-term growth. Point 4 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson explains that there are different types of bonds, including government bonds, corporate bonds, municipal bonds, and more, each with its own risk and return characteristics. Understanding the various types of bonds is important for investors to make informed investment decisions and to create a well-diversified bond portfolio that meets their specific needs and goals. Government bonds are bonds issued by governments to finance their operations, such as the U.S. Treasury bonds. These bonds are considered low-risk investments because they are backed by the full faith and credit of the government. While government bonds provide a lower yield than other types of bonds, they are typically viewed as safe havens for investors seeking stability. Corporate bonds, on the other hand, are issued by corporations to finance their operations. These bonds are generally considered riskier than government bonds because they are dependent on the financial health of the issuing company. Corporate bonds are typically rated by credit rating agencies, such as Moody's and Standard & Poor's, based on the issuer's creditworthiness. The higher the credit rating, the lower the risk of default, and the lower the yield. Municipal bonds are issued by state and local governments to finance public works projects, such as roads, bridges, and schools. These bonds are typically tax-exempt at the federal and state levels, making them attractive to investors seeking tax-free income. While municipal bonds are generally considered less risky than corporate bonds, they can be impacted by changes in the economic conditions of the issuing municipality. Other types of bonds include high-yield bonds, also known as junk bonds, which are issued by companies with lower credit ratings and offer higher yields, but come with higher risk. International bonds, which are issued by foreign governments or corporations, can also provide diversification benefits, but come with currency and political risk. Overall, understanding the different types of bonds and their risk and return characteristics is essential for creating a well-diversified bond portfolio. By investing in a mix of government, corporate, municipal, and other types of bonds, investors can achieve a balance of risk and return that meets their specific needs and objectives. Point 5 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson highlights the importance of bond ratings in assessing the creditworthiness of bond issuers. Bond ratings are provided by credit rating agencies, such as Moody's and Standard & Poor's, and are based on the issuer's financial strength and ability to repay the bondholders. Bond ratings range from AAA, which represents the highest credit quality, to D, which indicates that the bond has defaulted. The higher the credit rating, the lower the risk of default, and the lower the yield on the bond. Conversely, lower-rated bonds offer higher yields to compensate for the higher risk of default. Investors should pay close attention to bond ratings when considering bond investments. Lower-rated bonds can offer higher yields, but they also carry a higher risk of default, which can lead to significant losses. Investors should also be aware that ratings can change over time, and a bond that was once considered investment grade can become junk rated due to changes in the issuer's financial health. Investors can mitigate the risk of default by diversifying their bond portfolio across different types of bonds and issuers. By investing in a mix of high-rated and low-rated bonds, investors can achieve a balance of risk and return that meets their specific needs and objectives. Overall, Richelson's point is that bond ratings are an essential tool for assessing the creditworthiness of bond issuers and managing the risk of default in a bond portfolio. By investing in a diversified mix of bonds with different credit ratings, investors can achieve a balance of risk and return that meets their specific needs and goals. Point 6 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson emphasizes that diversification is key in building a bond portfolio to mitigate risk and enhance returns. Diversification means spreading your investments across different types of bonds and issuers to reduce the impact of any single bond or issuer on your overall portfolio performance. A well-diversified bond portfolio should include bonds from different issuers, different industries, and different types of bonds with varying maturities and credit ratings. By investing in a diversified mix of bonds, investors can reduce the risk of default and minimize the impact of interest rate fluctuations on their overall portfolio performance. Diversification can also enhance returns by providing exposure to different sectors of the bond market. For example, investing in high-yield bonds can provide a higher yield, but also comes with higher risk. By diversifying across different types of bonds, investors can achieve a balance of risk and return that meets their specific needs and objectives. Moreover, diversification can help investors avoid concentration risk. Concentration risk occurs when an investor has a significant portion of their portfolio invested in a single bond or issuer. If the issuer defaults, the investor may suffer significant losses. By diversifying across different types of bonds and issuers, investors can reduce their exposure to concentration risk and mitigate the impact of any single bond or issuer on their overall portfolio performance. Overall, Richelson's point is that diversification is key in building a well-balanced and secure bond portfolio. By investing in a mix of different types of bonds with varying maturities and credit ratings, investors can reduce the risk of default and interest rate fluctuations and enhance returns. Additionally, diversification can help investors avoid concentration risk and achieve a balanced portfolio that meets their specific needs and objectives. Point 7 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson suggests that investors can purchase individual bonds or invest in bond funds or ETFs for greater diversification. Both options have their advantages and disadvantages, and investors should carefully consider their investment goals and risk tolerance before making a decision. Individual bonds provide the investor with a fixed interest rate, a set maturity date, and a known payment schedule. They are generally considered less risky than bond funds or ETFs because the investor knows exactly what they are investing in and can hold the bond to maturity. Additionally, individual bonds provide more control over the bond portfolio and can be used to tailor the portfolio to the investor's specific needs and objectives. However, individual bonds also require a significant investment, typically requiring a minimum investment of $10,000 or more per bond. Moreover, individual bonds can be difficult to trade, and it may be challenging to find a buyer or seller in a timely fashion. Bond funds or ETFs provide the investor with greater diversification than individual bonds, as they invest in a mix of bonds with varying maturities, credit ratings, and types. Bond funds and ETFs also provide liquidity, as they can be easily bought and sold throughout the trading day. Additionally, bond funds and ETFs typically have lower minimum investments than individual bonds, making them more accessible to a wider range of investors. However, bond funds and ETFs come with their own set of risks. They are subject to interest rate risk, reinvestment risk, and market risk, which can impact their overall performance. Additionally, bond funds and ETFs charge fees, which can impact the investor's returns. Overall, Richelson's point is that both individual bonds and bond funds, or ETFs, can be effective tools for building a diversified bond portfolio. Investors should carefully consider their investment goals, risk tolerance, and investment horizon before making a decision. By investing in a mix of individual bonds and bond funds, or ETFs, investors can achieve a balanced portfolio that meets their specific needs and objectives. Point 8 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson discusses the impact of interest rates on bond prices and returns. Bond prices and interest rates have an inverse relationship, meaning that when interest rates rise, bond prices fall, and vice versa. The reason for this inverse relationship is that when interest rates rise, newer bonds are issued with higher interest rates, making existing bonds with lower interest rates less attractive to investors. To compensate for this lower demand, bond prices must fall to increase the yield and attract investors. Conversely, when interest rates fall, newer bonds are issued with lower interest rates, making existing bonds with higher interest rates more attractive to investors. This increased demand leads to higher bond prices, which decreases the yield and makes it less attractive to investors. The impact of interest rates on bond prices and returns is important for investors to understand when building a bond portfolio. In a rising interest rate environment, investors may experience a decline in the value of their bond portfolio. However, this decline in value is temporary, and investors who hold their bonds until maturity will receive their principal back in full. Moreover, a rising interest rate environment can present opportunities for investors to reinvest their bond income at higher rates, potentially enhancing their returns over the long term. Additionally, investing in bonds with varying maturities can help mitigate the impact of interest rate fluctuations on a bond portfolio. Overall, Richelson's point is that interest rates have a significant impact on bond prices and returns, and investors should be aware of this when building a bond portfolio. By understanding the inverse relationship between interest rates and bond prices, investors can make informed investment decisions that meet their specific needs and objectives. Additionally, investing in a diversified mix of bonds with varying maturities can help mitigate the impact of interest rate fluctuations on a bond portfolio. Point 9 in the book Bonds, The Unbeaten Path to Secure Investment Growth by Hildy Richelson emphasizes that taxes can have a significant impact on bond investing and that investors should carefully consider the tax implications of their bond investments. Interest income from bonds is generally subject to federal and state income taxes. However, some bonds, such as municipal bonds, are exempt from federal income taxes and may be exempt from state income taxes, depending on the state of residence of the investor. Investing in tax-exempt bonds can provide investors with tax-free income, making them an attractive option for investors seeking to minimize their tax liability. Additionally, the tax treatment of capital gains and losses from bond investments depends on how long the bond is held. If a bond is held for less than 1 year, any capital gains or losses are taxed at the investor's ordinary income tax rate. However, if a bond is held for more than 1 year, any capital gains or losses are taxed at the investor's long-term capital gains rate, which is typically lower than the ordinary income tax rate. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.